Welcome to the Oil Minute, creating unlimited value in the oil patch. Today we're going to talk about TMX again, ethanol wars, and the EIA Weekly. So the first story, TMX is on track, according to its CEO. Now, TMX is Trans Mountain Expansion. It's a pipeline that's going to be expanded or proposed to be expanded from the Alberta region of Canada to the west coast of Canada in British Columbia. So according to the CEO, it's on track for an end 2022 in-service date. Now, if being delayed by over 5 years, going through endless court challenges, having to be sold from a private company to the government of Canada and be nationalized and go to the Supreme Court of Canada means that you're on track, well then, I guess you're on track. But, all humor aside, TMX among the three West Canadian pipes that are being proposed for either repurposing or building, which would be TMX, Keystone XL, and Enbridge Line 3. Amongst all of those, I actually think that TMX has the least amount of risk, which is crazy to say, but it's just because the actual asset now is owned by the government. And not only is it owned by the government, it's owned by a left-leaning government, federal government in Canada. That would be the equivalent of the Democratic Party in the US nationalizing the Keystone XL pipeline and actively pushing for it. So that's pretty crazy. It's an extremely high business case, though, this pipeline. So the exporting heavy crude out of Western Canada, ultimately for Asia, most likely, is where most of those barrels will go. Now, the reason that it's extremely lucrative to do that is because the marginal heavy barrel of crude into Asia from wherever it comes from is not going to come from Canada. It's going to come from most likely the Atlantic Basin. So Canada only having to ship from the west coast of North America into Asia versus somebody having to ship on a VLCC from the Atlantic Basin out to Asia, well, there's a big difference in cost there. And basically Canada, or whoever the producers are that are selling it on TMX to Asia, their netback is going to be extremely attractive, relatively. So it's on track. We'll see if it gets done. But again, it's kind of sad to say it's on track, given all that's happened. Staying on TMX, apparently there's a story in the same article that an oil shipment, I think a few months ago, went from Alberta and ended up in St. John, which is on the east coast of Canada. So how that happened was it had to be shipped on TMX, existing TMX, before it's being expanded. It does exist today. Had to ship it on TMX, store it in Burnaby, put it on a crude carrier, send that crude carrier down through Panama, transit the Panama Canal, then send it up the Atlantic to the east coast of Canada. Which is pretty mind-blowing. This makes no sense to me, really, because unless it was some sort of integration play or there were amazing terms of the deal that I just won't be able to see, it doesn't make a lot of sense in terms of the netback. So, and I keep saying the word netback. So to analyze how crude clears into a market, or where crudes go and how that affects the price of that crude back at the wellhead, whoever produced that crude, the netback, or the implied price received at the wellhead, that's what the netback is the final price of the crude wherever it's sold minus the midstream logistics costs to get it there. So those midstream logistics costs, if you can keep those down, your netback's going to be higher. If they're very high cost, then your netback's going to be lower. Examples of costs in this case would be the pipe, TMX, storage in Burnaby, the ship down through Panama Canal. Transiting the Panama Canal actually costs you money. Coming out of the Panama Canal up the coast into East Canada, not to mention the insurance and all the stuff that goes into shipping logistics. So it'd be incredible if that was to continue, because East Canada can source light crude from the North Sea. They can source light crude from the U.S. even. They don't have the Jones Act from the U.S. to deal with. West African crudes as well. If it was a heavy shipment, well, then they could also source in the Middle East, most likely, or Brazil or Colombia cheaper. So again, I don't think this will continue, but it's an interesting story to see how the netback can be affected by all the different logistics that go into an oil shipment. Okay, so back to the ethanol wars. I don't want to keep talking about this, but it just continues to evolve, and I think that I think it is my duty to talk about the ethanol wars. So I just wanted to re-examine Trump's proposal to send cash to these refiners that had their exemptions rejected for the RFS. And again, if you guys want a deeper dive into what this all means, it's in my past few episodes on Periscope and Twitter. So anyway, let's take a step back. So let's imagine that the exemptions are rejected, which they were, and let's imagine also that the small refiners who had the exemptions rejected received cash from the government as some sort of compensation. Who actually wins in this scenario? So to really examine this, let's take a step back. So if the RIN price is baked into the crack spread, which it is, then blenders pay higher prices for the blending components. Theoretically, they would pay the blending component price plus the RIN, so because it's baked into the crack. So the blenders are paying that. But then the blenders actually sell that RIN back to the obligated party, which is the refiner, after it's blended in. So that is a little bit of a loop, canceling out zero-sum game. In the aggregate, economically, high level, it seems to be a zero-sum game. The problem is that there are all these timing issues when you execute the trade to obtain the RINs or sell the RINs, sell the blending components that don't always match up, and there are different strategies on how to make money off of the RINs since it's traded in the open market. But fundamentally, it should cancel out. So if it cancels out, then it shouldn't really matter. And then the refiners are going to receive cash. So the big winners in this sense would be the refiners who receive the cash, because even though they're obligated, they're going to get compensated that RIN price in the blending components that they sell to blenders. So again, that seems to be a zero-sum game. And then you have this excess cash coming in, and that kind of seems like it would be a benefit, all else equal, to those refiners. So in the end, after all this back and forth between ethanol and oil, it seems as if the small oil refiners are the ones that are going to win, if it passes. So that's the way that I see that. The EIA Weekly. So the weekly EIA came out this morning, as always. So the good news is crude and gasoline both had a stock draw, so that's great. The only news that matters is that diesel didn't have a stock draw. In fact, it had a stock build, and it negated the last 2 weeks of previous stock draws. So I think we're 43, 44 million barrels above where we were last year. Because you have such a massive overhang in diesel market, I don't see any tangible upside for crude, because there's no incentive to keep run rates high, so that is a dampening on the crude demand side. Refiners can't turn off their refining system. It's not like turning off a light bulb and turning it back on. So they can only go to an operable minimum that allows them to maintain their systems. So they can't turn off completely. Diesel demand needs to pick up, but that's going to be dependent on weather. Also, maybe some agriculture demand in PADD 2 and at this time of year, just due to seasonal harvest and stuff like that. But even though diesel prices are continuing to get hammered, as most demand pull is not actually consumer, it's business or like freight, manufacturing, those types of consumers. Since it's not a consumer-driven market mostly, it's hard to generate demand through the lower end of the price quickly. So until that diesel problem is fixed, crude demand is going to remain low, at least in the U.S., and I don't see crude having an upside. So, it's great that crude had a stock draw and gasoline had a stock draw, and I'm sure that'll, generate some stories in the next few weeks of how gasoline's normalized and it's amazing, but the diesel is the problem. Keep your eye on the diesel, and until that is fixed, I don't see crude fundamentally having much upside. That's all I had. I'm Zachary Rogers, and this has been the Oil Minute.